Pleasure to speak with you about GoldMining Inc. This is the first time I'm speaking in San Francisco at this conference, and we come here every year, where gold mining gets to look outside as a company, and we see a $1,500 gold environment. Makes me think of a kid who's never seen snow in Christmas time or something like that. You know, it's going to be an interesting environment because we've spent 9 years building this company, starting out with our focus in Brazil and really broadening it to the Americas. And what I'd like to start with is to really kind of set the scene for what our strategy is all about and why we have focused on this style of business model. One of the things that happens during an extended bear market environment is that major mining companies, the big producers of any commodity, be it gold or copper, focus on deleveraging their balance sheets, reducing debt, paying down their debt, and staying financially nimble during difficult times. One of the first departments or items you cut out of your budget when you do that, when you deleverage, is you cut out exploration expenditures. And the second thing you do is you stop making acquisitions. And in the resource business, unless you drill holes, unless you make acquisitions, the pipeline of resources and reserves gets depleted. Only way to grow that is by making investments. Furthermore, over the last decade, we've seen an increase in overall timelines to permit mineral projects, be it gold, silver, or copper. It used to be that I remember listening to Rick Rule at Cambridge House conferences, and it used to be from exploration to production. Everyone used to always say it's a 10-year process. It takes 10 years just to get permits. I mean, it's become this even more prolonged process to be able to advance mineral opportunities. So the two charts here speak to some data that came out earlier this year from McKinsey. McKinsey, the research consulting firm, actually wrote extensively about the major structural challenges in the gold industry today. And it really starts with the fact that gold discoveries have decreased in recent years as majors have focused on cost-cutting measures. And resources and reserves by major gold mining companies are at a decade low. This really means that as we come into the beginning and early phases of a bull market environment for gold, we're most likely going to see more M&A activity. Because if you were to just organically grow your pipeline through exploration and development, it would simply probably not catch up with the need to grow faster during a recovery cycle. I look at this chart and I kind of take a couple of things away from it. The cyclicality of our business and commodities cannot be overlooked and is really at the heart of understanding, I think, the valuations. The capital markets completely walks away from the junior resource business when times are bad. And when times are good, frankly, you sometimes get pretty silly valuations on the upside. This is just a chart of the TSX Venture going back to 2002. And what you see form from 2012 on is an extremely long bear market. There are people here in this room that have seen these cycles way longer than I have and are far more experienced. But I would go out and say that I think this bear market we've had in gold since 2013 has definitely been one of the longest bear markets over the last few decades. Now, I hope you don't take this the wrong way, because if you're an investor, this has not been an easy period, right? But if you're in my shoes as an entrepreneur, I look at an extended bear market as a blessing. And I look at it as a blessing because if my business is basically shopping my Christmas decorations in January, right? If that's the concept that you go by, a long bear market environment allows you to really consolidate and put more deals together. And when you look at this chart, it shows you how this snowball effect that we've had with making larger and larger acquisitions has allowed us to put together a total resource portfolio now across measured and indicated resources of gold, 10.5 million ounces, and across inferred, or in the inferred category, 12.4 million ounces of gold resources. That's gold only. There's a copper co-product and some of our projects, and So the number on a gold equivalent basis is even greater than the 10.5 and 12.4 million resources of gold combined. Putting that into context, amongst all pre-production junior gold companies listed in North America, we now have one of the largest gold resource portfolios, and one of the metrics I look at is gold resource on a per share basis. So the leverage that we offer you as an investor, gold resource on a per share basis, is the highest in the industry. That's our just under 23 million ounces of gold in all categories, and the fact that we have 138 million shares outstanding. One of the things that we've done with our capital structure and this business model is to say, hey, with this kind of business model, you got to keep costs down. The last time our company went to market to do a private placement, Rick was talking about private placements and warrants and things like that. The last time our company raised money was in 2016. So 4 years, and our company still has about $7 million of cash, no debt. And so you can see we've been very conservative with the way we've managed our capital structure and our balance sheet. So when you look at our total acquisitions, they amount to about $80 million in share-based acquisitions. Some of the companies or projects that we acquired are listed there. We look at one interesting data point to look at is how much money went into the assets that we bought. That number is about $280 million. So $280 million of hard dollars were spent on the projects that we bought for total $80 million. Another thing we look at is peak market cap. So all these companies were public that we acquired. If you go and add up all their market caps back in 2011 at, let's say, $1,700 gold, that number is close to $820 million. Our market cap today is about $100 million. The reality here is that what we've also done, I think, creates a lot of efficiencies. Back in 2011, all these companies were separate entities, separate board fees, G&A costs, audit fees, legal fees, and you had single project, single country risk. By having brought everything under one umbrella with our company, we've cut out the extra costs. We have far more lean structure in terms of how we maintain everything, and allows us to realize much more of a diversified exposure. And this is what the diversification looks like. If you look at this portfolio, the fact that we're in 5 different countries in the Americas, we're in Alaska, we're in the Northwest Territories of Canada, we're in Brazil, Colombia, and Peru. This kind of diversification, this level of size when it comes to total gold resources, you seldom don't see in junior gold companies. This is the kind of portfolio that you would see in an intermediate gold producer, maybe even a company larger than that. And when you look at some of the resources and grades, it speaks to a couple of points. You know, one of the guys who really inspired this business strategy in me was an entrepreneur out of Vancouver named Ross Beatty. Ross Beatty formed a company called Lumina in the early 2000s. And they went and bought copper resources in the ground, the way we're buying gold resources in the ground. And I remember Ross would say that they were buying projects that the majors considered to be garbage when copper was at 50 cents. And he thought gladly, I'm happy to buy the garbage. Now, well, garbage is a bit too aggressive of a word to use. It's a question of economic or sub-economic, in the sense that at $1,300 gold, most gold companies are looking at projects that could be economic at maybe $1,100 gold, or some level that's lower. Projects that require a higher gold price simply become less attractive. And so our mandate over the last 7 years was to buy projects that in the eye of the market was sub-economic at $1,100, $1,200 gold. But you look at some of these resources today. In Canada, in our Yellowknife project, we have 2 million ounces of gold resources, and mainly a pit-constrained resource in Canada at 2.33 gram per ton grade. Year to date, we've seen a great response in the share price to the rising gold price environment. Gold price went up, and our share price went up from 75 cents to as much as $1.40, and has pulled back a bit because there are some warrants currently being exercised that are in the money, and that'll put another $3 million of cash, or we anticipate would put another $3 million of cash into the company. Those warrants are set to expire at the end of the year. Between now and then, feel free to come to our booth and get more information. I think we feel and we've seen in the market that gold mining has been 9 years in the making for exactly the kind of gold market environment that we're now seeing emerge and develop. And the size of the portfolio that we've put together, I don't believe you could put together in today's environment. If you had $500 million of cash right now, I don't think you could go out there and put together the size of the portfolio that we've put together, the resources we put together. This was really made possible due to this very prolonged bear market environment that we had. Strong insider ownership. I'm the largest individual shareholder in the company. I've been there since day one, and our various private placement rounds participated and put money in the company when the markets were tough. So we really have skin in the game that we've acquired through committing to the capital rounds that the company has done. As I mentioned, 10.5 million ounces of measured and indicated resources, 12.4 million ounces of inferred resources. I get asked quite a bit about where do we go from here? And honestly, I think we're in the driver's seat. I don't think we need to extend the capital structure and raise more money to build mines. I think many of the resources we have could be of interest in M&A transactions with different companies in the regions we're in. Maybe what we do with our company is spin out a royalty company. To have 6 or 7 projects and so many resources. This is actually the foundation for a very exciting royalty company that could be created out of this. And you see that structure be implemented with other companies right now, and we're having some fun in the royalty space with our uranium company, and I'll talk about that tomorrow at lunch. So what I'd like to encourage you to do is, if you're interested in learning more about gold mining and some of the ways that we're planning to grow the business, come and talk to us either at the booth. If you're interested to hear about uranium energy, a new company called Uranium Royalty that just filed its prospectus on Friday and is going to be doing an IPO starting on Monday. If you're interested in any of these topics, come and sign up at our booth to register to attend our lunch tomorrow. The lunch is going to be at noon in the Regency Ballroom, and our booth is just outside, and look for either myself or Canapa at our booth. We also do expect, hopefully, with gold mining to have some new acquisitions and news to share with you in the coming weeks. And so you can also see we're not done yet with this wonderful opportunity that we've seen in acquiring resource stage projects and building the portfolio so far this way. Thank you very much.